Good morning, everybody. It's Ed Yardeni, and glad to have you join me here on March 4th. Also glad to have Max and Bailey both join us. As I pointed out before, when my wife is in her home office here, they don't come visit me, but right now they're here, and very much looking forward to our conversation about the financial markets. Here, we've got a cold day in Long Island. Kind of cloudy, a little bit of sun, as you can see, coming through the windows there. But I don't know what the parallel is with the stock market. The stock market's kind of neither here nor there today. I guess, we've come a long way in a very short period of time. And so having a day or two of rest here kind of makes sense. The news from the economic side is nothing really terribly surprising. The economy's growing. We did see some cutting back in the GDP forecast of the Fed's GDP. Oh, I guess we lost both of them. Okay. So we did see that the Atlanta Fed's GDP now model reduced the outlook for real GDP growth during the current quarter from something around 2% to something closer to 2%. I guess that happened on Friday. And the construction employment the construction release was weaker than was widely anticipated. But that was another one of these January numbers. And it certainly looks like everything's pointing to weather having impacted January. So if it turns out that January was in fact weather affected, we should see better numbers in February and March. But I'm still thinking 2.5% to 3% real GDP growth. This week we get productivity and costs update for the fourth quarter, not the first quarter, the fourth quarter, and that should confirm that we had a 3-quarter run, consecutive increases in productivity being higher than expected. That's helped to bring unit labor costs down, and that's been probably the main reason that inflation overall has come down, at least on a year-over-year basis. Again, as we've discussed before, I'm sure you're reading what we're saying on inflation and what others are saying, and maybe it's a little bit confusing because we're using the year-over-year percent change. We do take out the food and energy to look at the core rate, and we even take out the shelter. And when we do that, the core CPI inflation rate, the core PCED inflation rate, as well as the headline versions of both of those are still consistent with inflation still moderating right through January, and consistent with the idea that we're getting pretty close to the Fed's 2% target. I think there's lots of good reasons, or there's one very good reason for taking shelter out of the CPI, and that is it, and the PCED, and that is that it's a lagging indicator of what actually is going on in the rental market. Even that market's a little confusing because we have seen data that shows that rents are going up in smaller towns and going down in larger towns. So maybe there's maybe that's something to be somewhat concerned about in terms of how quickly inflation might come down on the services side. But ever since Fed Chair Powell got us focused on the super core inflation rate, which is the services inflation rate, not goods, just services, for services excluding energy, which is really a tiny impact on services. I think it's basically electricity. But services excluding energy and then excluding shelter. And people have been kind of upset about what they saw in Friday's number on the PCED inflation rate. I think it's important to recognize that the Fed really can't micromanage every single component of the inflation numbers. That what it really needs to do, and what it is doing, is focusing on the big picture inflation news, and the big picture inflation news shows that it's continuing to moderate. So again, we've got an economy that's doing reasonably well. I think anything north of 2% is quite good, because 2% used to be the kind of growth rate we had prior to the great virus crisis. And many people thought that that was a stall speed, and instead the economy continued to grow at 2%. And that basically reflected an increase in the labor force of about 1% and productivity of about 1%. I think looking forward here, we should be able to do at least that. And I think we'll do more than that because of productivity. And again, I'm not sure it's a forecast anymore. We had 3 quarters in a row where productivity was very strong. That doesn't mean that it just consistently has to be strong every quarter, but I think we are seeing an environment with more productivity. Stock market seems to have bought into our roaring 2020 scenario, starting on November 30th of 2022. And that's when OpenAI introduced ChatGPT. And ever since then, the market's basically gone straight up in almost a vertical fashion, really, led by NVIDIA, led by the semiconductors, led by technology. But as we've been pointing out of late, it hasn't really been as narrow as people have been concerned about, because what's really been going on is some stocks have just been, off on a rocket ship, just soaring dramatically. And the other ones have lagged behind with merely 20% increases since the start of the bull market. But a 20% increase is bull market kind of gains. And so there's actually been quite a lot of bull market gains in the market. It's just some of them have been so remarkable that when you take things like the ratio of equal weighted S&P to market cap weighted S&P, it looks like that ratio is actually falling, and that's kind of confirming for some people that the breadth of the market is weak. And as I said, I think that that kind of indicator may be missing the extraordinary relative performance within the market. Lots of talk about bubbles now. Ray Dalio put out a piece on LinkedIn about a bubble meter that he's come up with. It's got 6 indicators, and fortunately, his bubble meter is telling us we aren't there yet. I think his reading is something like 52 on his bubble meter, and it needs to be more like 70, 75 to be in bubble territory. We're trying to duplicate that. I hope as a public service, Mr. Dalio offers updates on his bubble meter so we can all watch it together. But it turns out that if you take the 3-month rolling percent change in the S&P 500, that comes pretty close to being a bubble meter itself. So maybe we don't need to have 6 indicators to get some idea of whether the market is overextended in a bubble fashion. But I guess it's funny how this business is always interesting, never a dull moment, and it can be kind of hilarious at times if you're making money. If you're not, it's obviously not so hilarious. But it wasn't too long ago that everybody was worrying about a bear market and how long it might be, and then it wasn't more than a few days ago when people were focusing on the narrowness of the stock market, where those who were pessimistic were saying, well, this is not really a legitimate bull market because it's just a few stocks going up and everything else is languishing, and that's not a healthy situation. And now all of a sudden everybody's Googling bubbles, and apparently that chart's kind of gone into a bubble phase itself, as people are worrying about this being a bubble. It's true that when you look at a stock like NVIDIA, it's reminiscent of Cisco. It's reminiscent of exponential bubble moves that we've seen in stocks. But in this particular case, NVIDIA makes the picks and shovels that the AI gold rush miners need to have in order to do what they want to do with AI. I'm still think that AI is early on. I think so much money is being thrown at AI that a lot of good will come out of it, but I'm not sure it's going to be overnight. Maybe I'm wrong about that. But look, it's hard to short these things or to if you're waiting for an opportunity to buy these things cheaper, that may be hard between now and the next couple of weeks, because in a couple of weeks, NVIDIA is going to in San Jose and virtually is going to have its conference on AI, and I'm sure that's going to be jaw dropping kind of stuff, robots and conversations with machines and things like that. That will be pretty impressive. But right now, I still think we're in sort of the early stage of the AI revolution, and right now it's kind of more like autofill on speed. Speed. What did Benjamin Franklin say? Something like haste makes waste, and at least in terms of having it write term papers and substitute for what I do, it seems like we have to spend more time fact checking and correcting the mistakes that autofill does in this souped up version of autofill than that. So we'll see. You know me, I'm in the roaring 2020s camp. So anything that makes that work is like, hey, this is working great. So I don't really have a problem with AI turning out to be the technology that makes the roaring 20s roar. But I think automation, robotics, just simply managing things more towards productivity are already working quite effectively. What I'm waiting for actually is for Siri and these personal assistants that we have on our from Amazon and Google. I'm waiting to be able to actually have a conversation that makes sense, and I can order something, or that as I'm writing things, I said, would you just put the following phrases in? We're not quite there yet. I guess I should try out Microsoft's Copilot to see if that makes a difference. Anyways, I've talked enough. Let's get into the presentation of the charts that we typically do. And so this is the chart collection for the morning briefing, and the morning briefing is focuses initially on the geopolitics and domestic political risks that I think we shouldn't ignore. Just because I'm an optimist and bullish doesn't mean that I think it means that I have to spend more time thinking about what could go wrong. It's just there's so many people who do that for a living that they make my job easier. Just kind of read what they're saying, and that kind of covers the field. But the geopolitical issues environment is still potentially pretty dangerous between what's going on with Russia invading Ukraine, the Middle East, Taiwan. There's things to worry about. But from a geopolitical perspective, I think the market would really get concerned if the Middle East blows up to the extent of having a direct impact on the price of oil, the supply of oil, and that just doesn't seem to be the situation right now. OPEC has announced that they will continue to keep their production cut back, but I think that's not going to make much difference to the price of oil. And a lot of that has to do with China being in a property depression, the economy over there being quite weak. So we'll see how that plays out. The domestic politics is disturbing. I think we're all disturbed by how partisan and bitter it's become. It's pretty unsettling when both parties view one another as mortal enemies of democracy. That's unsettling. It shouldn't be like that, but it is what it is, and we'll see how that goes. So this country faces lots of domestic political partisanship, but you read U.S. economic history, and it's always been a crazy country. I mean, let's not forget the Civil War was one heck of a horrible confrontation between partisans on different sides of the issues back then. Slavery, obviously, and even like during World War II, when Henry Ford converted the Ford factory to making uh, uh, bombers that basically won the war for us. There's a really good series on one of the, maybe Netflix, one of the programs about the World War II and the bomber squadrons, and just how insanely dangerous that was. Basically, you had a 50-50 chance at most of returning from these bombing missions. But back then, Henry Ford went from producing autos to producing bombers. And you would think that we'd all be focused on, the war effort, and we'd all be united and all that. But there were race riots. There were all kinds of terrible things going on in Detroit, even in the midst of all this. So the country has a tendency to be a little crazy, and yet we continue to move forward. We continue to achieve. And as I've pointed out in the past, it's amazing how well this country has performed, how well the economy has performed, despite Washington's various meddlings in the economy. So that's it on the political side. And then I went and kind of did an anatomy of the bull market, and it's pretty impressive actually. But on the political side, this is just a chart showing, if you ever need this chart to show clients that you don't want to get too political when you're investing, you show them this chart because it shows that through thick and thin, the market tends to go up no matter whether it's blue or red administrations in the White House. And again, on the geopolitical side, we're watching the price of oil do very primitive technical analysis, and you can see we've seen some breaking out of this trend, but these are the big ones here. We'll see how that plays out. But for now, it looks like it's been amazing how well oil prices have stayed down in the face of OPEC cutting back output and the craziness in the Middle East. This is another chart we're looking at on a geopolitical basis with a geopolitical slant. This is the price of copper versus China's MSCI stock price index. This is going to be a big week in China. Their government apparently is going to roll out some more stimulus packages. Expectations of those have led to a huge rally. It looks big. It doesn't look very big, but I think it's a double-digit increase. But we'll see whether we break out from this or make a bottom here, a double bottom in the Chinese market. I'm skeptical. I mean, it could go higher, but I don't think we're about to see an amazing bull market here. I think again, property depressions based on what happened in Japan and in the U.S. Could take 5 to 7 years to unwind. And that's what's one of the things that's beating down their economy. And they've tried for a long time to stimulate the consumer, but between the negative wealth effect of the stock market and of their ghost apartments no longer being worth what they thought they were worth, consumers over there have to be pretty depressed. And so I think it's going to be pretty hard to stimulate the consumer. And that probably means that the Chinese government's going to fall back on what's always worked in the past and just export. And if they do that, then we're going to have a lot more deflation. They're going to be exporting deflation. And that's good in terms of keeping inflation down. It's good in terms of convincing the Fed they don't have to raise interest rates anymore. It's basically all good for us. So not so great over in China. Watching grain prices just as some proxy for how crazy things are between Russia and Ukraine. Obviously, Ukrainian exports of grain matter a lot to the global economy and to avoiding global famine. And we can see that those prices are coming down. So that's a good development. It's amazing how markets can work even in the face of crazy geopolitical times. Well, this market's working great. This is the stock market. It's been an amazing ascent here in the market. I mean, this alone is a bull market, but we've had two bull markets for the price of one. We bottomed back here on October 12th, 2022. We had a 10% correction. I mean, it's all going by the book. 10% correction, hit that line precisely. And now we're broke through this particular line, all-time record high for the S&P 500. All-time record highs, by the way, for the 50-day moving average and the 200-day moving average. I don't know if anybody else looks at these averages relative to their past performance. But I think when you got all three at all-time record highs, that's probably a pretty significant technical indication of bull market strength. So all this talk about a bubble is basically an attempt to argue that, well, this is going to wind up imploding. I mean, after all, this was October 12th, 2022. It was November 30th, 2022 that OpenAI came out. So you could, if you want to be the spoilers, say this was all AI hype and it's all going to blow up. Again, I think the actual technology may be not as advanced as one would think, but billions of dollars are being spent on the shovels and picks and the dungarees and all that one needs to continue to create AI productivity solutions, and some of that's going to work. This is the forward PE ratio of the S&P 500. I guess it's another way to watch out for a bubble. And here we are at 20. We had a very and have a very bullish outlook for the stock market at the end of last year and the end of this year. And we had some very bullish outlooks for earnings, as we still do. But the craziest thing we said over the past couple of years is that the S&P 500 might range between a multiple of 16 and 20. And we thought it would be closer to 20. And the reason for that is quite simply, but we think the mega cap 8 aren't going to go away. They're going to continue to have high valuation multiples. And we have to factor that in so that the old traditional fair value of 15 may not apply, at least for now, if you believe that these are real companies, which they are, in my opinion, with amazing products, amazing margins, and will continue to perform well. This is another PE measure. This is median versus market cap weighted, and the median forward is 18.2, which makes you a little bit more comfortable that we're not at 20 at least. And if you take out the mega cap 8, I think the median would be more like 16 for the median, and the forward would be more like 17, 18. This is another chart that we show. So this is a kind of breadth of the stock market, and you can see that the percent above 20 PEs was 44.4. That's quite high, but it was higher than that back here. But they're not giving stocks away the way they do in bear markets. That's the nature of bull markets. This is another bullish development that we've been focusing on, and that is we never really had much of a recession in forward earnings. Forward earnings had this modest recession here, and it was profit margin, which makes sense, but it was not revenues. Revenues remained very strong. There was no recession in the economy and in revenues. And now you can see forward earnings were back to an all-time record high. Not a big increase, but I think the S&P 500 is 7% above its previous record high on January 3rd. So I think that a small part of that is earnings, and the rest of it is the PE. Meanwhile, the Nasdaq's gone up to a record high. This is the Nasdaq Composite. The Nasdaq 100 went up before that, but they're both at record highs. I've seen some data showing that when the market in the past was down, the Nasdaq was down something like 20%, and then recovered back to its previous peak. You still got another 20% increase from there over the next year or so. So if history repeats itself, and again, that's a variation, I think, of about 10 different experiences, including even the one of 1999, which probably skews it a bit, maybe a lot. But there's, to the extent that this is a recovery from a bear market, and that to really feel like you're in a bull market, you want to be making money relative to where you had been at the previous peak. That's where we are now, and that could have some staying power, some legs. This is what I mentioned before on the ratio of equal weighted to market cap weighted. You can see that's been coming down, and that means the market's narrow, the breadth is narrow. But as we show here, it's not really the case. While the S&P 500 is up roughly 40%, the equal weighted is up a little over 20%, which is a bull market return. So it just hasn't done as well as the market cap weighted, but it's doing quite well anyways. This is another slice and dice on from a fundamental perspective on the breadth of the market, and you can see that forward earnings from a fundamental perspective, we have percent of S&P 500 companies with positive 12-month percent changes in forward earnings, and you can see that that is up to 70.5%. Before this bear market, and that bear market, the forward earnings on this measure were more like 90%. So that just means that there's room to grow on the earnings side, and earnings still are an important contributor to the market. This is the market cap weight, earnings weight, and revenues weight of the mega cap 8. They're now account for 28%. This is the performance of the sectors, and it's true that the market's been narrowly focused on communication services and technology, and that they've had these huge increases. But industrials are up 43.1%, nothing to be embarrassed about. 36% consumer discretionary, admittedly Amazon's in there. Financials are fine, 32.9, materials 28.2, and then you only got 20% in healthcare and some diminished returns from there. So still looks like a pretty good bull market to me. I mean, not everything's going to go up 40%. On a global basis, we've been saying stay home versus go global, overweight the U.S. relative to the rest of the world. And these didn't work out too well right in here, but now we're back on track with that kind of scenario, and we remain there. So there's a table here, figure 17, that you can look at on your own. But what it shows is that, and it hasn't been all the S&P 500 information technology and communication services. They're at the top of the leaderboard here. But information technology for the 400 is up 63.2%. The 400 industrials are up 49.8%. So look through that yourself, and you can see that it's been a pretty damn good bull market, any way you slice it and dice it. Let's take a couple of questions here. Okay. Yes, Masters of the Air is the name of the series on the bomber squadrons that won World War II for us, as did a lot of the efforts of a lot of other Allied forces. Okay, John, you are in good company. I think worrying if nationalist populism potentially dominates and hurts our economy. Larry Summers and Kissinger, as I am sure you know, have both pointed out that nationalist populism has always hurt badly economies because it runs an economy for political goals, not for what's best economically. If money were to ever therefore run from our markets, where might it go? Gold, crypto, what other assets? Okay, that's a good statement. Thank you. I don't see any other questions. I'll give you a chance here to ask another one, but we are almost at our 30-minute mark. So let's see if anybody's got a question or not. Gus, thoughts on Europe, specifically Germany? Well, thoughts on the world economy. China's in a recession, in my opinion, no matter what their data is showing. They certainly are in deflation. Europe, I think, is in a shallow recession, and they may stay there for a while. And leading the way in terms of weakness is the UK. They're in a recession for the European MSCI. For the EMU, the European Monetary Union, Germany is on the edge of a recession. I think Germany's got some really serious structural problems. They are an industrial power. They are famous for their engineering, for their cars, and they're facing tremendous competition now from from the Chinese in electric vehicles. And so that's an issue for Germany. In addition, the Germans, as along with other Europeans, I'm not sure if they've completely sorted out their climate change attitude towards energy. We'll see how that plays out, but that certainly cost them the past couple of years as a result of the disruptions caused to their energy supplies emanating from the Russians' invasion of Ukraine. Europe, like a lot of parts of the world, has a demographic issue of aging populations, and Germany certainly has that problem. But like the U.S., Europe's got immigration. We've got immigration, illegal immigration. The question is, how does that play out? I think as a social political issue, it creates a lot of havoc in the short term. Historically, immigration has been a good thing for countries, but I think it's been a good thing as long as it was fairly well controlled and you kind of let people in that you wanted to let in. So at this point, I think the economic benefits of illegal immigration, in my mind, are at least completely offset, if not more than offset, by the potential political and social upheaval that it's causing in Europe and in the United States. More populism, going back to John's point. Ed, where would you invest fresh money now? Thank you. S&P 1500. I think the mid caps are doing better. I think they continue to do better. I think mid cap, small cap technology, mid cap, small cap industrials. But if they have like an amazingly impressive AI conference at NVIDIA in San Jose in a couple of weeks, that could get everybody juiced up all over again about AI. So I think that's something to consider. I'll take one last one here. What is typical pullback you might expect? Is this pullback to reset? Beats me. I'm not good at doing these things. Every now and then I give it a shot, and sometimes it works, sometimes it doesn't. I think I had a pretty good call on the last year's correction in the market from August through October 27th. It was a 10% correction. I pretty much called it. This has been a straight up move. It feels like it's very powerful. It feels like it can continue to go. I'm not sure we're going to get a correction from anything I can see out there, unless something blows up in the Middle East and the price of oil suddenly soars, up above my triangular formation on the charts I showed you before. Okay, Lucas, hi, Dr. Ed. I will go back to last week's someone's question. Do you have a view on steepeners? It's a tough one, actually. You guys are coming up with tough ones at the end here. I guess my thinking is the 2 years probably where it should be, and the 10 years probably where it should be. So I don't know that I've got at this point a strong conviction that we're going to have a major change in interest rates. I think the Fed is going to push back against the idea that they're going to lower interest rates anytime soon. And I think that still keeps, I don't know. I mean, I guess the 10-year bond yield could go up a bit more if the market becomes more convinced about that. Okay, that's it for now. Thanks very much. Have a really good week, and I'll see you again next week. Thanks for tuning in.